Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and/or financial topics. So let's dive right in, take a look, see what's going on today. If you want to follow me, it's at @Finance. And if you want to join our community, finding-value.com, where I dive deeper into all these topics and sectors, looking for investment opportunities and sharing those opportunities with everyone in the community. We have a special coupon code that's still going on. Special is the code. It ends up being $25 only for the first month on the monthly membership, and a $100 discount on the yearly membership. And you can always swap from a monthly to a yearly and reuse that special coupon code if you'd like. Lucas says, in terms of energy consumption growth, the West is becoming irrelevant. Asia accounts for 80% of global energy demand growth. Asia's energy consumption is growing 4% per year, compared to just 1% in the rest of the world. If you want to understand the future of energy demand, look to Asia, not the West. And the yellow is Asia. The gray is world, excluding Asia. So yeah, the growth is definitely in Asia. And one of the things that Asia has undergone recently is a real estate recession. It started in 2020. Those recessions generally last 5 years. So we're probably coming out of that recession into a recovery phase. Uh, they generally do, countries generally do stimulus at the bottom of those real estate busts. And then you get into the recovery phase, which then increases the demand for oil, for commodities, for real estate, steel, iron ore, lumber, all that stuff. And I think that China could be a main driver of the commodity boom. And right now, if they're located in a recovery phase of real estate coming right on up, I think things look good. I think things look good. And we'll continue to go over some of this later on. It says, Grady, I'm not a permabull because I post bullish big picture commodity charts, or a gold bug because I'm bullish gold in a resumed secular bull. No, commodities are simply in a new super cycle bull since 5.5 years ago. Just try and help people to get on the right bandwagon. And this is CRB index versus Dow Jones, false breakout, flag pattern. It's looking ready to rip. I'm in the same camp as I would say Grady is on the long big picture view. Once you see things and once you understand where all the value is, you can't unsee it. It's all part of the cycle. So when I talk about the three pillars, technical analysis, market cycles, and ratios, what that does is it strips away the opinions of people and it exposes what the data has to say. Valuations will be cheap at bottoms of markets. Valuations will be expensive at tops of markets. So what you see in the cycle is you'll see commodities are cheap, financial assets are expensive. That's what this is saying in this very own ratio chart. And when things start to balance out and turn, they squeeze into falling wedges, and we get a squeezing of volatility too. And that's exactly what we're seeing in all these different charts in the commodities and in the ratios. So that's where the opportunity is. If a lot of, I think what people misconstrue, I'll use that word, they misconstrue this. They say, if it doesn't move in a set time frame, it's you're choosing. Well, I'm trying to think of the phrase that they always use. It's about missing an opportunity, right? An opportunity loss, or however you want to call it. But in reality, since people can't time markets that well in terms of short term, your opportunity is the value. That is the opportunity. That is the bottom of the market. That is your signal. It's not necessarily the price movement or the squeezing in the pattern, which it aids in the determining factor of buying something. It's verification and validation that the technicals match the fundamentals or the valuations. But the opportunity, yes, it is part of the squeeze, but it is the value. The value is the opportunity because that is what shows you that you're at the bottom of the market. That is your signal. Now, technicals will try to get you closer to that bottom, but nothing's perfect. We don't see billionaires that are only technical analysis driven. Maybe there's a few, but there's very, very few if there are. It's all about buying it's all about using the correct signals and knowing what the opportunity is, in my opinion. It says, aside from this exciting moment for silver, let us not forget that copper appears to be on the cusp of a major breakout, one that could also lead to a true price discovery phase, in my view. Few resources are more essential than copper for what the world is trying to build: onshoring, AI-driven infrastructure, grid and utility upgrades, the expansion of electric vehicles, and even addressing housing shortages. This is not the time to take an overly bearish stance on this metal, in his opinion. And I overlaid certain fractals on top of this, like NVIDIA's ready to break out, and this looks ready to go to me. I think we're going to get a big breakout. It's going to run. We've got deficits as far as the eye can see looking forward in 2026 and onward. So copper, I think, is a huge opportunity. The equities themselves, they've already bottomed. So this is the big bottom here, the falling wedge, the double bottom, the breakout, the retest, and they're already running. So the equities, they know it's coming. What you want to do is, if you see a chart that looks bullish, go look at the equities in copper. And then if you go look at the equities and they're all breaking out like this and making new all-time highs, you're in a bull market, guys. Like, it's undeniable. Now, I've been reading on Twitter, a lot of bearish people on Twitter, and maybe it's just because they get a bunch of views. I don't know. I read the Melody Wright 50% decline in housing. My question is, would copper and the copper equities be doing this exact thing in front of our eyes if we're going to see a big deflationary crushing period? I just don't see how that works. Why are people positioning in copper equities and copper itself, which is Dr. Copper? It's a function of the economy. How could these be going higher, but yet someone calls for a 50% market crash in housing? Those two are about as incongruent as you can get. Incongruent means that they do not match. They're not the same. So I look at all these people calling for crashes. I look at all these people on Twitter playing the short-term market movements and all these different types of patterns, and they're trying to estimate where these things will go. Incorrectly calling shoulder head shoulders topping patterns like uranium back in 21, 22, 23. I don't know. That they must not see the cycle. They must not be tying together all of the information from all the charts. During a slowdown, gold is the safe haven asset, and that has ripped. I think the slowdown may be behind us, and perhaps China is part of that because of their uh, real estate crash. Perhaps that had an impact on commodities for the past few years. So here's one. Charlie and I sleep well because we only buy when the price is substantially below our conservative estimate of value. That margin of safety is our protection against the unknown and the unknowable. No matter how much we like a business, how strong its moat, or how honest its management, if the price does not provide that cushion, we pass. The world is full of attractive businesses. It is rarely full of attractive prices, says Warren Buffett. And I'm trying to adopt as much as I can of these guys because I think they're right. And not just right. It doesn't mean that they're even great investors. Like, I'm sure they're good and they're great in terms of their statistics. I think you could do better than what they did. But again, they're very conservative. They grew up through the Great Depression. They looked at things from really avoiding loss and doing stupid things. But one thing I really do think they have nailed, and it's not just margin of safety, it's value. Value protects you against being in the wrong stocks at the wrong part of the cycle. And that is the most valuable thing because you can undoubtedly tell what the value of the company is without question to some degree. Now, you can argue that a company is a little bit more expensive because of the high growth that it's experiencing. That is completely all well, you know, for an argument. But you can't justify a price to book or a price to cash flow or some of these valuations that are at like 60. I mean, that's you just don't want to be there. And if you never go there, if you never ever go there, you never get kicked in the nuts that bad. Now, I'm not saying that you can't get kicked in the nuts buying at the bottom. You can try to buy the bottom and you can still get a 30 to 50% haircut very quickly. But it keeps you at the bottom and you can wait things out. You can wait it out and ride it out if you buy cheap. And even if you experience a 30, 50% correction, if you buy something really expensive, you can't ride it out. Because if you ride it out and you're wrong, those could correct 90, 99%, depending on the company that you're buying. And that's what we see. If you buy at the top of, say, an oil market, if you look back in history, some of those companies were 99% off their highs. Now, you don't want to be buying towards tops of market. So I think he's got the value thing correct, and I think it works repeatedly in all markets, in all sectors, and the only thing it requires is patience. Patience that the market cycle turns back in favor for that particular sector or company. So if you really try to tear apart these guys' as, some of the quote greats approaches, that's the one thing that stands out the most is value will always protect you. And if you always, 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 always stick to some of these, uh, how can I say it? Some of these, it's not sayings, but some of these rules, maybe, it will protect you. Lucas says the market hates oil. That's why I'm long. I'm not an oil permeable. In fact, I'm bullish on all forms of baseload energy, excluding hydro, and have investments across these sectors. It sounds like me. Right now, I believe we have a unique setup. The only real source of global supply growth, U.S. shale, and particularly the Permian, is approaching a plateau or even decline, just like every other major shale basin. This view isn't mainstream. Instead, people are worried about demand. I'm not. Will demand drop during recession? Absolutely. Not necessarily, guys. That's not a true statement. We've gone through recessions where demand did not go down. The growth slowed, but it didn't, the growth was still there. Will it be temporary? Of course. Let's look back. The worst demand shock in modern history happened during C-19 lockdowns. Demand dropped 8%. That was a total shutdown, though. Oil prices even went negative. And then 21, 22, and 23, it was positive. In other words, demand took care of itself. Meanwhile, since 2020 bottom, the oil and gas equities XLE have outperformed both the S&P and NASDAQ despite the tailwind of the AI bubble, bearish sentiment towards oil and gas, record low hedge fund positioning in energy, energy's weighting in the S&P near all-time lows. What I'm saying is simple. We're early. Energy sector as percent of S&P 500 is only at 3% at the bottom of the cycle. I agree. I agree with most of what he says. I just look out. I look out years and I say, where's all this oil going to come from? And that doesn't mean just because I can't see where it's coming from that it's not there. I look out there and I say, I think we're going to struggle to meet this. Now, could we pull 115, 120 million barrels of production out of the world? Maybe, maybe. Um, can we pull, with the decline rates of shale? I don't know. I'm not sure if we can. So if we're at almost 110 million barrels of demand or slightly thereunder, we're getting close. We're getting close to that peak. And I don't think people are going to nail the exact peak. So we'll see what happens with shale. If shale does start to decline, it's going to get interesting, I think. Very interesting. As I expected, analysts are upgrading their GDP growth predictions to 5% for 2025 for China. This means that, yet again, China's economy will grow by more than double that of the United States. So China's economy is forecast to grow faster than expected in 2026. Remember that real estate bubble that they went through in recession? Remember the stimulus that they're doing? Remember that the majority of oil consumption and growth is in Asia? Yeah, China's economy is forecast to grow faster than expected. Maybe that's where the commodity growth is going to come from. And everybody's worrying about the United States, but China, the big boy's coming. It's coming and it's growing fast. Money is one side of every transaction. The more control the government has over money, the more control they have over everything. It is totally true, and that's why they have control over it. Silver miners, buckle up. Miners back test completed versus silver. Let's see what that looks like. So that's Silj divided by silver futures pricing. That's really a back test. We've got a falling wedge breakout. And this here, yeah, it's moving lower. It's just a consolidation. So everything looks fine to move on higher for Silj. A lot of the junior companies, they look very explosive, very explosive. So I think we have a long way to go. I don't think they're done yet. Hardest part about winning trade, knowing when to sell, not getting overconfident, knowing when to add more. Show me the answers. I don't even think that is the hardest thing. It's not knowing when to sell. You're never going to 100% know. I think it's being able to hold and do nothing for most people. They want to sell. It's not about getting overconfident. I don't even know what that means. Knowing when to add more, no. It's not about the hardest part of a winning trade. The winning. So I'm up many. I've got at least 20 or 30 stocks well over 100%. Well over. I've got a handful over 10 bags. I've got maybe 9 or 10 bags or more. Actually, let me think about all this. It depends. I might be double counting one or two 10 baggers because I own some companies that 10 bagged in multiple accounts. But it's probably around 10 or something since 2020. I've got a whole bunch over 100%, probably half the portfolio or a little under half. And I'm including companies that I purchased less than a year ago. So it's not hard about a winning trade. It's not even about a winning trade or losing trade. What you need to understand is that there are cycles. There's times where you want to be in certain sectors and there's times where you don't. And you want to hold the entire move. You want to reduce taxes that you pay. You want to get cheap entry prices. And then you want to hold for the 10, 20, 30, 40, 50 bagger that is possible. And that's all about knowing the cycle. So if you know the cycle, you know when to buy, you know when to sell. It's not about a winning trade. It's about understanding the cycle is running the show. That geopolitics is not running the cycle. They're reacting to the cycle, in my opinion. It's all part of the cycle. War is part of the cycle. It's not driving it. And people, I think, misunderstand that. At least that's my view. So it's not the hardest part about a winning trade. It's not about holding. It's just holding it. Most people, they can't. They're not able to hold, and that's their problem. So it's not knowing when to sell. If you know the cycle, you know when to buy. And even if you know the cycle, even if you're learning about it, I still think that holding is the toughest for most people. Demand weakness. U.S. oil demand was at 21-ish million barrels per day in September, a new record high for the month. It is up 535,000 barrels per day or 2.6% year over year. August was revised up from 20.884 to 21.195. So demand pretty resilient in the United States. It is making all-time highs for this time of year. MasterCard spending pulse, U.S. retail sales excluding autos were up 4.1% on Black Friday compared to Black Friday of 2024. MasterCard spending pulse, U.S. retail sales up 4.1, with e-commerce up 10.4% compared to 2024. I wonder how much of that is due to inflation. We probably have the same amount of people buying crap, but inflation's up 4 or 5, 6%. I don't. I didn't really buy anything this Black Friday. I didn't really see anything. Like I didn't see any great deals where I'm like, man, I really need to buy this. I ended up buying nothing for myself. I don't know about you guys, but that's all I've got for today. So we'll end it there. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. Special to coupon code. And that's all I've got for today, guys. So we'll catch you next time. See ya.